Good morning, everyone, and thank you very much for joining me this morning. This is the morning market review. My name is Russell. I'm a senior market specialist at FXCM. My email address r@fxcm.com, and today's Monday, it's the 11th of July 2022. Hope everyone had a good weekend. Just bringing up the high risk investment warning. I'll keep this on screen for a few moments. Here is our market commentaries disclaimer. And just our references, MarketScope, CNBC, and tradingview.com. I'll just put the daily yield curve on. Just want to see if this inversion continues. Sorry, this is the weekly yield curve. I just want to see if the inversion continues for the week. Let's go through the CNBC morning note, and we'll take it from there. Hey, Howard, morning to you. Hope you had a terrific weekend. Thank you very much for joining. The headline reads as follows: European markets set to slide at the open as investors prepare for more US inflation data. European stocks are expected to open lower Monday as investors prepare for more key inflation data out of the US for this week. The lower open for European stocks comes after the region's markets closed higher last Friday as investors digest a stronger than expected jobs report out of the US, which showed that the economic downturn worrying investors has not yet arrived. The jobs report, while good for the economy, could embolden the Federal Reserve to continue its aggressive rate hikes in the coming months to fight persistently high inflation. It will be tested with a slew of US earnings from major banks and the latest consumer inflation reading coming up this week. The June Consumer Price Index on Wednesday is expected to show headline inflation, including food and energy, rising above May's 8.6% level. Elsewhere, investors in the UK will be watching developments surrounding the political uncertainty in the country after Prime Minister Boris Johnson announced last week that he would be resigning as Conservative Party leader. Johnson said he would stay on in the post while a successor was found, and a number of high-profile conservatives have announced their leadership bids over the weekend. In Asia-Pacific markets overnight, Hong Kong's Hang Seng Index fell more than 2% after news that China imposed fines on heavyweights Tencent and Alibaba. China imposed fines on several companies, including tech giants Alibaba and Tencent, for not complying with anti-monopoly rules on disclosure of transactions, according to Reuters. There are no major earnings or data releases on Monday. And just going into earnings season, we want to just keep an eye on the earnings and, more importantly, the forward guidance. Okay, the market's always looking forward, so the forward guidance is going to be very important in this regard. Okay, so to start off, we can see that we still got this inversion here, so we want to keep an eye on that. The reason we want to keep an eye on that is the longer it stays inverted, the more likely a recession. It doesn't guarantee a recession, but if it kind of pops out, then maybe we're able to effectively move out of the inversion. I'm not convinced moving out of the inversion is completely putting the markets in the safe area. What we need to just keep an eye on, of course, is the rate hikes, because let's just move this here. So this is what's kind of happening at the moment is we've got an inverted yield curve. An inverted yield curve has a negative slope. What an inverted yield curve is telling us is that the short terms have a higher yield than the longer terms. So in this case, we're looking at 2 years. So we'll just put 2, and we're looking at tens. This over here is interest rates, and what we see is, let's just take a look at the twos are at. Okay, so we had three, let's call it 3.1. Okay, we'll just round. So let's put it at 3.1, yeah. $3.1, and what are the 10s at? Let's just take a look there. Okay, well, we're also close to 3.1. Let's call it, let's not round this one past 3.08. Okay, so we'll keep it, let's just take a look at the twos. It's not much in it. It's very flat, in fact. With the slide inversion. So we're at 3.09, so there is like 2 basis points between. So, but nevertheless, let's just, there is an inversion, so we'll keep it at 3.08. So you can see the 2 years are higher than the 10 years, right? That's the problem, that's the inversion. Okay. Now, if we move, I mean, 2 basis points, nothing really is very flat. It's much flatter than I've given than I've suggested here. It's kind of more like, it's like really like that, you know. But the idea here is, let's say that the 10s manage to move above. Let's just say we get some sort of slope, okay. Well, then we've got to contend with the 75 basis points for July, plus there's going to be 50 probably in September, one would expect. I mean, market conditions change. And the deal with that is let's just throw in the Fed funds rate here, is that the Fed funds rate and the 2 years are very closely correlated. We've looked at this previously. Whilst the twos may have overshot, okay, that's not really what I'm suggesting in today's webinar. What I'm suggesting is that if the twos carry on moving up, then the Fed funds rate carries on. So if the Fed funds rate carries on moving up, I beg your pardon, then the two is likely to carry on moving up. And if the twos carry on moving up, okay, then it's quite likely that any sort of flattening gets offset. So that's one possibility, unless the twos have overshot, right? Unless the twos have overshot, but we don't know that yet. So what we can do, what we are in danger of, the rise in yield curves, the rise in the 2 years, I beg your pardon, the rise in the 2 years, keeping the yield curve inverted. Now, what's the big deal about an inverted yield curve? Well, it's telling us that we expect lower interest rates in the future, and lower interest rates are used to generate a flat economy. So we're kind of anticipating weakness ahead. That's what an inversion is telling us. So we're expecting weakness ahead. It's fair to say that this gradient that I've put here is clearly incorrect. The gradient here is way too steep. Okay, so I concede that, but it was just to, I guess, make the point that there is an inversion here. We closer to being flat, but flat we're not quite at. It's still an inversion. So given that inversion, there is heightened probability for recession. Why is there heightened probability for recession for inversion? Well, because all recessions are preceded by inversions. If we don't have an inversion, then there's less of a probability of a recession, right? So that's the idea. Hey Anna, morning to you. Yeah, Howard, absolutely, we'll definitely do that. Just keep me in the loop. Yeah. All right. Let's just take a look at the dollar. So dollar is looking really strong to start off the week. What we can do is just take a look at the baseline, which is sort of a very quick snapshot of what's going on in the markets. I probably don't have all the instruments here, but you can just see these are all 4 hours. So the US dollar here is moving up, Euro moving down, Pound moving down, Aussie moving down, US moving up relative to CAD, a gap down in Bitcoin here, US dollar moving up against Swissy, US dollar moving up against Yen, DAX coming under pressure, S&P coming under pressure, oil flat, gold flat. All right, so that's kind of what we see. So I think a lot of the effect. I think the cause is the US dollar here, right? The rest is the effect. And last week's candle on the US dollar is an inverted hammer. It's a bearish candle. Effectively, what happened last week in the US dollar is we had a situation where here is the open. Here's the open. So we kind of opened here. We had a really steep appreciation up until the week's high, and then something happened, pushed us down to the point that we actually closed lower than the open. Not quite on the week's low, but not far off it. So this was the question we ask is who was in the control? Who was in control? Oh, sorry, this is the daily chart. Okay, thanks, Anna. Who was in control at the end of the week? So let's just redo this. Sorry about that. Let's just redo that. I want to do it on a weekly scale, which is different. All right, so let's just take a look at, so we've got the axes like this, and we've got the open over here. What I suspect happened is that we dropped initially to there, okay, and then we shot up here, and then we closed off the high. Still a positive week. What I was referring to, what I wanted to refer to the daily, which I was not correct on, is how come we've got this big inversion here? And I think the way that I can tie that into the week is, well, how come we're off our high for the week? And that was really the non-farm payroll, wasn't it? Really the non-farm payroll. So non-farm payroll took the dollar off of its high on the weekly, and actually on the daily, it had this bearish candle. This bearish candle on the daily, by the way, is a strong candle. Look at the range. It's an outside day, right? It's an outside day. So let's go here. So the idea here is there we go. Is that take a look at how we opened for this week. Okay, so we've got a slight gap open here. This is where we closed. Okay, this is where we closed end of the week, and then we've got a slight gap open, and the daily candle is basically putting us very close to last week's high. If we go back to the daily here, you can see the gap open here as well. Here's where we closed on Friday. Okay, here's where we opened today, and now we're pretty close to the high here. And I think that we just want to keep an eye on the obviously last week's high. The reason we want to keep a sorry, my system's just holding it. The reason we want to keep an eye on the high for last week is because at the moment we don't have the higher high yet. So if we take out last week's high, then we get a higher low and a higher high. So that's what I wanted to show you. I thought this was the weekly chart. It's the daily, but I'll show you what I was looking at. Nevertheless, a potential reference candle. In other words, we may get the next dot of swing here. All right, so it's not quite the same thing when I look at the weekly chart. Because in the weekly chart, we've got the the series of high lows is just a matter now of taking last week's high out over the course of the week. And we're going to see if that's going to be the case, because we're going to have the inflation data out this week. And if the inflation data comes out strong, then the likelihood of the Fed funds rate increasing, I think it's pretty much it's become sort of almost a certainty, given the non-farm payrolls, that we'll get the 75 basis points. So again, just draw your attention to the fact that we've got this inversion now. A couple of things that we want to okay, yeah, Rob's asking, but what? So Rob's question, I think I understand that NFP gave the green light to the Fed to hike rates, but why did equities rise? It seems back to front. Let's take a look at that. Let's take a look at that in a moment, Rob. Definitely, we'll take a look at that. All right, so we just want to keep an eye on the dollar. We want to keep an eye on the dollar momentum here, which is clearly strong. I had something I wanted to do. I lost my train of thought. Oh, I just wanted to go back to the inflation data. I just want to go back to not the inflation, the employment data. So let's just go through to our trading view. There's the non-farm payrolls, I think we can all agree were good. It's a coincident indicator. The forward data, I think we've still got to be very much on top of. Okay, the initial claims. Okay. So I just want to see if the initial claims carry on moving up. So we've looked at that. And we've looked at the continuation claims, the continuing claims. They're starting to tick up, right? So this is, we're not going to do this in more detail at the moment. We did this, I think, quite well last week. This is starting to tick up now to the point that it's above that 3-month average. Why are we using 3 months? We're using it just because it's no particular sort of magic behind it. It's just measuring it, the average over the quarter. But then there's something else that came up on the non-farm payroll report, which we haven't mentioned. So we just want to go to the participation rate, which eroded ever so slightly. So let's just go through to the participation rate. Here's the participation rate. Labor force participation rate, okay. Let's go to this one here. Okay, so you can see this is the participation rate, and it's still way below the pre-COVID levels, but I'm not as concerned about that. I'm more concerned to take a look at the trend here in terms of the participation rate. Let's just put the participation rate in terms of peaks and troughs. So we've got a peak. So let me just do this. Let me do this properly. I beg your pardon. There we go. Okay, it must be a peak. And here is our trough. And here is our lower peak. And this is monthly data, okay? So it's not daily data, it's monthly data. There is not much sort of day-to-day fluctuation. And then, of course, the question is, well, have we got a lower trough? We actually do have a lower trough here. This over here is slightly lower than this trough. Okay, so in terms of trend analysis, just in terms of trend analysis, the participation rate that came out on Friday, kind of in the background, actually starting to show some signs of weakness as the initial claims are moving up, and as that initial claims moves into the continuing claims. This to me is kind of the worrying factor. The coincident indicator, by the way, the coincident indicator was really good. It was really good. However, let's also apply trend analysis to that. Let's just see if we can bring up our, let's see if I can get the right data here. I want the non-farm employment change. This is it. Let's just get rid of the logarithmic here. And if we can just kind of move in on this section here. Okay. Here's the beginning of, here's the beginning of 2022. It's just on an absolute basis. Trend has us down, right? Trend has us down on an absolute, just to make it red. So the red line, absolute. So yeah, we beat. Okay, sure, we beat. Okay, but the trend's down on the job creation. That's coincident. Forward-looking, starting to erode slightly. Still want to keep an eye on that. What's behind all of this? Inverted yield curve. What's behind that? Rates looking to short-term rates looking to move higher. That's still very much on the table. We want to see what happens with the inflation this week. Very, very important. So the non-farm employment certainly seemed okay, but some sort of erosion certainly seems to be apparent. Okay, let's go back to Rob's question now. Okay, what's a potential answer to Rob's question? The NFP gives the green lights for the Fed's hikes to go ahead. Why did equities move up? Why did equities move up? So the potential answer that comes to mind, Rob, and again, I'm going to just tag on that subject to correction, is because, well, can they really move up as aggressively as is being suggested, given that the markets are forward-looking, okay, and given that the forward data is starting to show signs of erosion, the cracks starting to emerge? Yeah, we've got the green light for the 75. Do we have the green light for the 50? I'm not sure about that. We're going to just have to wait and see. If the inflation data comes in weaker than expected, maybe the aggressive tone gets toned down slightly. I'm not sure. Obviously, this is all supposition, but that's one possible answer to, well, what happened on, why did we move up? Now, Friday's candle, by the way, is actually very ordinary. Taking a look at the US 30-year, let's just understand, yes, we do have an uptrend. What do I mean we have an uptrend? Higher high here, Rob, higher low. Okay, that's after the previous day, higher high, higher low. So we've got the swing over 2 days. Okay, what about the actual mood in the market? Well, we actually closed pretty uncertain. Yeah, the bulls managed to take price higher, so there is some bullishness there. Okay, but what have they actually done here, Rob? They've set up a potential lower leg. Okay, this is a potential turning point. Now it's on the daily. The turning points, I think, are much more useful to us on the weekly. And unfortunately, when I looked at the US dollar, initially I was confused. I thought I was looking at the daily, but this would have been interesting if it was a weekly. But nevertheless, there is a potential dollar turning point here. Well, guess what? There's a potential turning point to the downside over here. Okay, so that's possibly one explanation. Again, taking on that subject to correction. But the idea here is, whilst on the daily, we've got the higher high, higher low, okay, and we end off sort of uncertain. Not quite the same picture on the weekly, Rob. Here, look what we have instead. Instead of the higher high, higher low, we've got the lower low, lower high, lower low. Okay, yeah, there is a little bit more positivity because of Wednesday, Thursday, but then Friday shows some sort of uncertainty coming in, and we've still got this nasty looking top here, which means if we take this out, we possibly head for the movement down. So yeah, initially the job data really looked good. It really looked good, but I think the markets are kind of uncertain. I'm not sure how aggressive the Fed can be. That they've communicated that they are aggressive, but there's some cracks starting to appear. A very difficult situation to be in if you're a policymaker. Guess what? That's what stagflation is. Stagflation's a policymaker's worst nightmare. They don't know what to do. So that's kind of what I think may be behind it. Again, I'm not 100% certain, but the idea here is, yeah, we had that positivity, but I'm not certain we ended off all that positive. All right. Yeah. So the volatility is, as traders, we need the volatility. So that volatility is certainly what we need, but I think that we want that volatility to work for us in the same direction as trend. So on Friday, the volatility was working against us because the trend's down. Okay, so, and the volatility was showing upswings Thursday, Friday, Wednesday, Thursday, Friday, right? But again, let's take a look at this in terms of a broader analysis, and we're looking at the Dow Jones here. Let's take a look at this, and I think we must look at DAX next, and then we'll end off. But let's, I would suspect DAX and US 30 probably very similar. Let's go here. Remember what we're looking to do. We want to find the flow, sort of the heartbeat, okay? And then we want to work with the heartbeat, okay? What do I mean work with the heartbeat? Let's change colors here. We want to, that's not so nice. That one's better. Okay. So we want to look for the rallies and see if we can short them. We want to look for the rallies. We want to, and only of course if the primary trend is down. Primary trend must be down. Okay. I'm pretty sure primary trend's down. For how much further we've got to go, I don't know. See, calling the bottom, that's the tough part. But now take a look at this. Okay, let's go back. Let's see if we can pick up here's the rallies, which we, in hindsight, could have shorted. Here's sort of the rallies. In hindsight, we could have shorted. Possibly 2 here. This one might have given us a whipsaw. The second one, certainly. Here's the rally we could have taken advantage of. Hang on. Next question. Is this a rally? Can we take advantage of that? So what do we look at? We look at classical patterns. Okay. Let me just what am I doing here? Yeah. I think I need my coffee. I haven't had my coffee yet this morning. I am doing strange things for some odd reason. I had the right tool, but I was trying to pull the word, the paint across. But look, so what we're trying to deal with is patterns here, continuation patterns. So here is a ascending wedge, a rising wedge breakout. Here is a flag, okay, breakout. What's the other popular one? Pennant, okay, breakout. You can also get something called a triangle, okay, breakout, pennant, triangle. I haven't drawn them quite, but the point is not so much what the pattern is. That's just to help us, I guess, identify if this is a 2-3 correction. 1, 2, 2, 3. 1, 2, 2, 3. Okay. 1, 2, 2, 3. 1, 2. Sorry. 1, 2. 1, 2, 2, 3. 1, 2, 2, 3. 1, 2, 2, 3. 1, 2, 2, 3. Now, if this is a legitimate 2-3, well, we want to see if we can get in on the downside here. Now, just in terms of a pattern here, I don't think it's an easy pattern to identify, but if I had to give it a sort of a name, perhaps a pennant, perhaps a triangle, something like this, yeah? Something like that, okay, which seems to fit the peaks and troughs the best. So now, are we going to break to the downside? Go down to the hourly, and now it's looking very interesting because on the hourly, trigger 1, trigger 2, look where the stochastic is, very, very weak. So we're a little bit late here if we wanted a short. Okay, this action took place in the Asian session. Okay, we're session late here, so maybe some sort of pullback here gives us the opportunity we're looking for. Let's just take a look at the DAX. Similar type of analysis. Let's just take a look from the top down. I want to make sure I'm on the weekly so I don't make that mistake again. So you can see that the weekly support here is holding, isn't it? This weekly support here is holding. But look where the stochastic is. Our momentum is really, the price is under pressure. Make absolutely no mistake there. The weekly price is under pressure. As long as we stay in the lower quintile, this support over here is looking very, very fragile indeed. Very, very fragile. Okay, now we go through to we can go through to our daily. What's interesting about the daily here is the narrowing of the Bollingers. There did seem to be some sort of respite, okay? But the way I'm thinking of it is, well, maybe this is the 2-3, and I'm looking for the next push down, right? If that's what I think may be the path of least resistance, time to go down to the hourly. What's happening on the hourly chart here? Well, this is interesting because we are getting the crossover, trigger 1. Here's trigger 2. Look where our stochastic is. You see? So we are under pressure. There's no doubt about it. The bounces last week. The markets, I think just to end off here, is that the markets are generally efficient. You can debate the point, but you'll be arguing against academia if you say that markets are inefficient. Okay, Technical analysis has that issue, by the way. They argue that markets are inefficient. I think that you can marry technical analysis into an efficient market, but I may be stretching that. But the point is, I am personally a person that believes the markets are efficient. I do believe that. That doesn't mean that the pricing is efficient. Okay, it means that the markets are efficient to adapting to information. Okay, that's what it means. Now, information may be inefficient. That I think is very plausible. So there could be, for example, you take a look at Twitter. Okay, Twitter. Do I have it up here? I don't have. Twitter has been a really interesting case study because we've kind of been looking: is the deal going ahead? Is the deal not going ahead? Well, now it's pretty clear it's not going ahead. It seems like we are heading into some sort of legal battle. But we didn't know that information until it was really released. And then the markets would adjust to that. And I think that's very much kind of what's happening here is that there is information that's been released, and then it has to be digested, and then the market prices would price that in. That's what discounting is. Discounting is pricing in the information based on future expectations. So I think under sort of that type of a scenario, the expectations here still seem to be absolutely bearish. Absolutely bearish. Where I think we have a slight advantage, and I think that we have an advantage over people that don't use the COPOC, is that if we just take a look at the DAX, is that I think we are getting pretty close to the bottom here. Where is the bottom? I have no idea. There is probably pain to come depending on how the market prices in information. We're now moving into earnings season, but at some stage, the COPOC will turn up. It's not going to go down forever, but when it turns up, I think it's going to be so much sort of blood out there, you know, that's the time I think we kind of are in a really good value position. So this is quite interesting now, trying to marry the weekly stochastic momentum, which is pressuring the market to the downside. It's going to put this support under huge pressure. So that's the one, and then we've got to try and marry that with the monthly COPOC, which at some stage will turn up. I don't know when, of course. So we just kind of sit back, relax, and we don't force anything. You can't predict the COPOC, you can only react to the COPOC. But by the time it turns up, I think everybody's kind of been really hugely disillusioned with the market. So it should be somewhere around there, right? And that's kind of, I think, where the bottom is. But we haven't turned up yet, so I think the pain's still there. We did see that Tencent and Alibaba were fined heavily. Let's just go through to the China 50 here. So what's interesting about that is that the COPOC has turned up for the China 50. The COPOC indicator is not an outright buy. It's not a buy signal. You can't use it to buy. What it's telling you, okay, what's telling you is that there are good companies out there. It's not telling you which are the good companies. It's just saying, all things considered, according to the way this is constructed, there is a good probability that we are pretty near the bottom. And if that's the case, now's the time to do the fundamental technical analysis to see which are the companies that are catching the bid. So it doesn't mean just blindly going to sort of a Tencent Alibaba. I haven't done an analysis on Tencent or Alibaba. I have no idea whether they're good or bad companies. But the point is, the Copac is just a tool. It's nothing more than just a tool from a bird's eye view. But the point is that the China 50 started to bottom. The DAX looks like it is certainly near a bottom. I mean, it could drop, I think, to -20, just based on sort of previous type of cycles. Again, that's a guess. What's missing here? I think the US market. I think that's where the pain's going to be driven, and we're going into earnings season now, so that might sort of exacerbate some sort of push down. We're very clear to going under zero here. I think that might be driven by poor forward guidance. So can it be that the DAX is globally a leading index at the moment? You know, Chris, I would never say no, but I'd have a hard time. I've got to think about it. I'd have a hard time thinking that the US market gives up leadership. It's just too big in terms of market cap. You know, it's a giant. The second place, I think, is a fraction of kind of US. So again, that's why I think a lot of the global movements driven by US sentiment. Where there could be a point, Chris, where there could be a point is in terms of the different makeup between the DAX, say, and the US markets. What I mean by that, I think that the DAX is more cyclical in terms of established companies, whereas there would be a more growth orientation to US companies. But I don't think the US 30 we would call growth. I'm not sure if I've answered that question, Chris, but I'm kind of thinking probably not. And again, I'm going to just tag on that subject to correction. Does that help? If the DAX does turn up though, and the US 30 remains down, I think we would still very much be interested in the DAX because Copac's turned up. But it's just a tool. It's just a tool. Then we've got to do the Copac's the easy part. Then the next part's the difficult. Then we try spot if the opportunities are there. So just I think one more. Yeah, exactly. So we won't know until we have the clear answer, which we don't. Well, I think one last thing, and then we can call it. Let's just go back to our phase analysis, which is, I think, probably a very, very useful thing to keep in your toolbox because markets are so complex. The three phases. Okay, kind of looks like this, I would imagine. Something like that. So yeah, you've got your renewed confidence, quiet. Let's put in the labels. Then we have your improved earnings. Now, this would be the longest and the most ordered part of the bull stage. Improved earnings. And then you would have the most dangerous, but also the most lucrative, would be your rampant speculation. This is the most volatile of all of the. This would be speculation. This would be the most volatile, but also the most lucrative, high risk, high reward. And then what would happen is you would kind of have, I think, probably quite a short drop over here. This would be abandonment of hopes. That's the first phase of the bear. I think we are past the abandonment of hopes. Okay, now we're going into earnings season, so I think we kind of have declining earnings here. Okay, and then the big question, and again, this is an unknown, have we passed panic selling yet? That market capitulation, which is kind of like a waterfall, okay, which would be, now, what I suspect happens, Chris, what I suspect happens is that the COPOC probably sort of starts going below zero somewhere in this, I suspect, and then it kind of turns up over here. So I'm not sure if we kind of have hit that panic selling. It's kind of a weird sort of morphing of declining earnings into panic selling. It's a very strange, I think, odd business cycle. I would just attribute that perhaps to the stagflationary nature. Not only that, I would say we've had an odd 2.5 years, right? It's just been a very, very strange 2.5 years. So we've kind of got some sort of amalgamation, it looks like, of these two. But I think the turning up of the COPOC will make a lot of things clearer. Will make things a lot clearer because there's as you say, there's a lot of unknowns here. And I think the whole market has to deal with that. That's the issue. And I'm asking, big question for German industry: will Nord Stream 1 be turned back on again after maintenance? I don't know. Good question, Anna. I don't know, but I think that we are getting. The point being, I think we've got this weird amalgamation between declining earnings, panic selling. I'm not sure if we've hit that capitulation stage. I think that if we can get through US earnings and see where the COPOC is for the US, has it turned up above zero or has it dropped below zero? That I think will help us kind of move us into here. Renewed confidence. What is renewed confidence all about? Renewed confidence. Let's just understand what renewed confidence is. Renewed confidence is the time when there's absolute bargains, but nobody wants to touch them because they've been so burnt because they got involved sort of in the rampant speculative stage and they exited at the panic selling stage. Well, who would want to go back into the market after being treated like that? You know, it's kind of, you've been chewed up and spat out. But that's exactly when the pros are getting interested in the market. Good companies at cheap prices. Good companies at cheap prices. It's a very difficult environment and cycle we're in. This market is so difficult in terms of the variables we're looking at. Nevertheless, the difficulty, I think, is exactly the reason why we've got to defer back to tools that seem to work. I'm a big fan of COPOC. Very few people know about it, by the way. Very few people know about it. I don't understand why. It's such a powerful technical tool. All right, I think we can. And it's saying, if not, that will cause panic and fuel rationing in Germany. And perhaps that's why, and I'm just again adding to the conversation, perhaps that's how we get from -7 to -20 in the COPOC. So we are moving down, we are below zero, but we haven't turned up. Where do we turn up? That is the big question mark. All right, guys, let's wrap up here. I think it's a good start to the week. Let's see how the markets perform today. We'll do it all again tomorrow morning. Thank you very much for joining for the first webinar of our week. Cheers, guys.